Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you. It's a little bit different with how I use it. Every week I do a number of videos. I do a daily video, then on the weekends I do a weekly video. I also do an intermarket analysis video. And what I do for my last video of the week is I go through all the daily charts that I look at and I pick out those charts that I really didn't talk about all that much, or if at all. Then I put them together and present them in this video so that we can get some insight or some clues that maybe we've been missing, because we tend to look at the charts that are really telling us something. Well, at least I do this. I tend to dismiss the charts that aren't really telling us much, but it's still good to go back and look at them because sometimes you might get some additional insight. This is being prepared for Monday, September 18th. The first chart that I'll show you is a chart of the VIX, and I don't show this in any of the videos. I pretty much save this chart for this video. This is a longer term chart. You see a moving average of the VIX on here. The VIX is on the chart, but it's invisible. How we usually use the VIX is we use static numbers from about 12 to the downside to 20 on the upside. Well, you can see by this chart that we don't always stay within those static numbers. The VIX is also dynamic. There'll be a period of time when it goes up into a higher range, and then another time when it goes into a lower range. And that's what we try to track on here. We're following it over on the right-hand side, noticing that the VIX has really been coming down. Even though the market's been running into some difficulties lately, the VIX is still at a very low reading. And we're wondering, is it going to start to establish a new range? We had been from 20 to about 27 to 28, and now we're dropping below this. And we're going to see, will we have a new range established going forward? Another chart is the VIX, and then I take a 3-month average of the VIX and then a ratio between the two. I mainly follow the red line. Now, this is continuing to go up. Even though the VIX has been going down lately, this is going a little bit higher, showing that fear has been increasing. To match up more with the chart we just looked at, we want to see this red line come back down. So we're not really seeing a lot of uniformity there with this. Another study that I do with the VIX is I look at the VIX and the S&P 500, and then I take a correlation between the two. Sometimes the VIX isn't really insightful, and there's a lot of different charts that I use to measure fear and greed in the market. This is one of those charts. When we get a really high reading with the correlation, sometimes that means that there's going to be a move in the market. And sometimes that'll mean a top, other times it'll mean a bottom. We don't really know. We have to use other charts to give us some context of that. Right now, we're getting a very low reading, which is why I haven't been showing this chart. Then another study for fear and greed is a thing called the skew index. The VIX looks at the money options. Well, the skew index looks at out of the money options. And similar to the VIX, when this gets up to a really high level, the market is anticipating some kind of a move, where when we top out with the VIX, that usually means a bottom in the market. With the skew index, you can see other times when we had an extreme reading, sometimes that marked the top, sometimes that marked the bottom, sometimes that marked the continuation of what was already happening. We're not up into this red area or down in the blue area right now, so this is really not telling us that much. Then we look at the RSI on the VIX itself, and this is an RSI 9 period. We're looking for extreme positive or negative readings, and we're not getting one right now. Then we look at the MOVE index, which measures the volatility of bonds. That's on top. And then in the middle is the VIX, volatility of stocks. And then the green line here is the spread between the VIX and the MOVE index, just to give us an idea, what is the general direction that the spread is heading. And then the red line is the S&P. What I pay attention to most is on the bottom, and that's the correlation between the two. The higher this goes up, the more they're having a tendency to go in the same direction. We look at the VIX to MOVE ratio. So we're looking at the volatility of stocks divided by the volatility of bonds, and then that's giving us a ratio, and it's showing that we've been going down a little bit more, so we're seeing this ratio going up. Then I can't usually show this chart. This is a daily chart of the equity put call ratio. It's really strange because I do other studies based on this indicator, and those charts update. It's just the daily chart doesn't seem to update in a timely manner, so I can't often show that. The interesting thing about this is this usually goes up when the market goes down, and we had a pretty significant down day on Friday, but the equity put call ratio actually fell. Because this can be pretty sporadic and chop around quite a bit, using moving averages and longer term studies gives us an idea of what's the overall trend. So the fact that this doesn't update is not that big of a deal to me. Here's one fear gauge that we do follow. When this is going down, that means that fear is decreasing. And you can see we've been pretty flat, but we're slightly declining here, even though we had a down day on Friday. We've been watching volume too. It's been well below average, which is not necessarily strange for summertime. Well, we really saw a spike up in Friday's session. That's because it was quadruple witching. And you had all kinds of things that were expiring. You had all kinds of things that had to take place. And so we really saw volume pick up. We'll likely see it really drop off. Whether it's going to go back down to below average or not, we're not quite sure. The market's really not in a trend right now, and we're mixed as of right now, technically. So that just shows a real indecisive market. And when people see that, they're less likely to jump in. Then we have the Fed meeting in this upcoming week, and people might want to wait ahead of what their announcement's going to be. So volume could start to drop back off. Keeping an eye on where are we in relation to the all-time high. Where we closed on Friday is over on the right-hand side. Over closer to the left is the all-time high. We're down 7.64% from the all-time high. Technical alerts are put out by stockcharts.com, and the last I checked, you don't have to be a member to be able to access these. This is for the whole week, Monday through Friday. And when something is red, that means it's negative. When something is blue or green, that means it's positive. And these are generated, we read them from the bottom up, and they're generated automatically. And they don't just apply to the S&P. There are different sectors that we can look at. There are different indexes. They even keep an eye on what's going on in Canada. And when any kind of technical event happens, it's registered on here, and we can see, well, we had a down day on Friday, so all of the signals that were generated were pretty much negative. There was a couple that ended up being positive, but again, as the market's going up or down, this can kind of give us an idea of what's happening in the market overall. Then we look at 5 indexes that I follow. I follow lots of indexes, but the main stock indexes are the Dow, the S&P, which the S&P is what I focus on, the QQQs, the NASDAQ 100, the mid caps and the small caps. And Stock Charts also has this tool that takes their chart as of right now and ranks it on a score from 0 to 100. The higher the score, the better looking the chart. When I'm looking to go long in something, I'm not even going to look at something unless it has a score in the high 80s to low 90s and looks to even be improving. Okay, some people may want to have a lower score because they want to try to get at a lower price. And then what I do is I just rank them on their scores each week. Coming in first place are the QQQs, giving us a score of 95.5. Now, this chart isn't all that helpful right now. We've been going down. The Qs have been jumping all over the place, where this line has pretty much been going flat. It's because we were so strong earlier in the year, even though we're pulling back, it's not really influencing a lot of the technical indicators that are used to calculate the score. Coming in second place is the S&P 500. Also kind of flatlining right now, but it's coming in at 85.7. The Dow, represented by the diamonds, doing okay at 67.9. Then we have the mid caps at 49.4, and then the small caps, represented by the IWM, which is the ETF for the Russell 2000 index, it comes in at 41.8. Some short-term charts. We do have the Stochh RSI that I've been talking about in the daily video. That's one of our short-term indicators. And believe it or not, when we shot up on Thursday, we went overbought with that indicator. When we came down on Friday, now we're oversold with that indicator. So it shows you how touchy that can be. Another short-term touchy indicator is the Williams percent R, but not quite as touchy right now. It's below 50 and declining, but not giving us any kind of an extreme reading. We look at the CCI 14 also for extreme positive or negative readings, and then the CCI 20. And because we've been trendless right now, these shorter term indicators are not telling us much. Then we have a thing called the boom indicator, and I start off by putting this in the short-term section because the top study right here is the 20-period moving average study. If this keeps going, then we might drop down to the 50 and the 200. This would be intermediate and long-term. But this measures how far away is price above or below the moving average. because the moving average tends to act like a magnet, or prices will zip back to the moving average if they get too far away. And we're not really getting any kind of an extreme reading now. We're just about in the middle. We can use this like an oscillator when we get extreme positive or negative, and pretty much across the board, it didn't change all that much this past week. We have a short-term rainbow chart going from 10 periods up to 50 periods. This, we look at longer term to give us an idea, how are the lines flowing? And I know it looks kind of cool and everything, but we're getting into a choppy time right now where the lines are starting to come closer together. If we turn and go back up, we would want to see these lines flatten out or smooth out. And if we really turn and go down, we would see all of these lines roll over. But we're just kind of in the middle right now. We have a moving average study. And again, this starts in the short term because we have a 20-period exponential moving average, then a 50 and a 100. And we're not getting any kind of an extreme positive or negative reading currently. Keeping an eye on the fundamentals, where we look at the S&P 500 just based on price, then the earnings. And this is a little bit misleading because we're flatlining here, even though we've been going through earnings. It can take a long time for these to update. And so that's why we get not a real helpful tool right here. We also can look at the PE ratio, the price to earnings ratio. The higher that goes, the more expensive the market is. And then an inverse of that is the yield, or how much of a dividend does the S&P pay out. Some intermediate term charts. We have the Connors RSI. You could almost put this in the short term category because it's pretty spastic. It works a lot like a regular RSI. We look for extreme positive or negative readings, whether we're above or below the dashed line. The CMB composite is meant to be a standalone trading system. I don't use it like that. When you're crossing the red or the green line, that's supposed to mean something. I just use this like an oscillator for an extreme positive or negative reading, and we're just about in the middle. We keep an eye on the 100-period moving average. And when we're in more sideways markets for extended periods of time, we're in that right now, but it hasn't been lasting that long. I'm talking about for years at a time. The 100-period moving average kind of comes into play. When we're going up or going down with more force, we don't really use this moving average as much. And so we're far away from it, and we're not really getting any insight. The vortex measures buying power or selling power. We're seeing the green line on top, but it is declining, and we're seeing the red line on bottom, but it is also declining. So this is positive. On balance volume, we look at, are we above or below the moving average, and what way is the moving average moving? We're below the moving average, and the moving average is starting to decline. So that's negative. We have a 200-period moving average study. This measures all of the stocks that make up the S&P 500. How many of them have their 200-day moving average going up, down, or sideways? We've been chopping more or less sideways here for the recent period. And then below, we have a 50-period moving average study where we've been chopping around in there as well. We didn't get anything updated on the point and figure chart. There's no new X's or O's. There's no signal that's been generated, so I haven't been showing that. The percent B indicator measures when we're either above or below the upper or lower Bollinger Band. Right now, we're just about at the midpoint. The intermediate term rainbow goes from 50 periods up to 100. We're still up near the higher end of the rainbow, and these lines are still fairly smooth overall. So it doesn't look like we're really falling apart in the intermediate term. We're just seeing more of a pullback. Standard deviation, how are we above or below the price? Doesn't matter if it's going up or down, but it looks back over the last 10 periods to get the standard or average price, and it just shows that when this is dropping, that means we're pretty much going sideways. The special K daily chart, I refer to that every day in the daily videos. We're still positive. This is a very long-term trend oscillator that we use, and when we cross over, you can see we crossed negative in 2022, then we crossed over positive almost a year and a half later. So we don't get a lot of signals from this chart. The Pring bottom fisher, it tries to determine when we've climaxed to the bottom of a move, and it looks like we could be bouncing up out of that. This is pretty much flatlining right now, so it's not telling us anything. The Sean trend meter is down in this yellow area, so that's more neutral. Then we want to measure how far away are we from this anchored moving average, which goes back to the all-time high. Price is up here, the anchored moving average is down here, so we're still very far away from that. We also want to know, are we above or below the 200-day simple moving average? We're still above it, even though we've been coming down lately. We look at the S&P 100, which are the biggest stocks in the S&P 500. Sometimes we see some divergences here. Lately, the big stocks have been outperforming the rest of the S&P 500, but we're not really seeing anything all that drastic on these charts. Ease of movement. What's the path of least resistance? That's on the bottom, and we're above zero and actually advancing, so that's positive. Up on top, we have a different kind of chart. It's an equivolume chart. Green is positive, red is negative. The thicker the bar, the more volume went into a particular move. You can see we have a really thick candle for Friday because the volume really went up. So this kind of gives us more of a graphical representation based on colors to kind of get a better idea of what's actually happening. The Erin indicator tries to measure the difference between buyers, which is the green line, and sellers, which is the red line. When we're above zero, that's the oscillator that's calculated down below. And when we go above that level, we're positive, but we've been flatlining. And so this hasn't been recalculating very much. The copy curve, we have been working off of a recent buy signal here, but we're rolling over. If we don't see a real move in the S&P to the upside, we're probably going to lose this buy signal pretty soon. Some long-term charts. We go from 50 periods up to 250 periods and then make a rainbow. We're still near the upper end. These lines are still having a tendency to flow up overall, even though we've been pulling back. So in the short term, we're seeing a little bit more problem. Intermediate term is still hanging in there. Long term is also hanging in there. Now, that could always change going forward, but as it stands right now, things are still hanging together. Then we have a longer term moving average study. I have a 50 period on top just for reference, then 150 and 200. When we're above this blue line, that means that we're more positive, even though we've been ticking down we ticked down on Friday. Then we have a weekly chart of the S&P on top and a weekly chart of the German DAX, which is their major index. Sometimes these have a tendency to go in the same direction. They're not doing that now. So this hasn't really been helpful. Then we take the 10-year yield and we subtract the German 10-year yield, and that gives us this line up here. And sometimes we can compare that to the US dollar index because they will often have a pretty strong correlation with each other. It's improving a little bit, but still not really helping us all that much as the dollar's been going up. The interest rates have been going up, and they've also been having interest rate increases in Germany. Then some support and resistance. This is what I refer to in every daily video. We're above the downtrend channel upper line. This is the chart. How's this chart was constructed? We looked at the June 2022 low and the October 2022 low, drew a trend line from point A to point B, then went up to the all-time high and drew a parallel line to this lower line. And for a while, in the spring, we were bumping up into this area, and it looked like this may be providing some overhead resistance. And we did. We came up, fell back, came up, fell back. Well, we were finally able to break through this. And so this isn't really relevant right now, but we're still keeping an eye on this. If we really start to fall, we'll be seeing if this trend line comes back into play. Then we go from the COVID low to the all-time high, draw a line, and then just separate this into 25% chunks. And we're not really showing any kind of a reading right now, but earlier we were using this as upper resistance, but we were finally able to break through that, and that turned things more positive. We have a short-term fib study on here where we're above the 100% retracement level. So this is pretty much in no man's land now. Longer term, we're also in no man's land. And then very long term, we're also kind of here in no man's land, which is why I haven't been showing these charts. Then we look at the Vixen, which is the VIX for the NASDAQ 100, where we were coming down to a very low reading, even though we bounced up with Friday's decline. But overall, it's just showing there's not a lot of fear in the NASDAQ 100. Then we have a study which looks at an equal weight ETF of discretionary and compares it to an equal weight ETF of the staples. And we're going up overall, even though we've been declining lately. This means that discretionary is outperforming staples, which is what we're also seeing in some other studies that we do. And when this is happening, that produces more of a growth environment rather than a value environment. Then we have a weekly chart of the QQQs, and we also plot an anchored moving average going back to the all-time high. we're still well above this level. This is the NASDAQ 100 Fibonacci studies, where we're still above the 61.8% retracement level. Here's the bank ETF, which has really been under a lot of pressure. It's down below its 50-day moving average and still in a basic downtrend. The financial sector, though, generated a recent golden cross and is showing a little bit of an improvement. And then when we compare financials to the S&P, they're still underperforming and chopping more or less sideways, but they're not as they're negative, but they're not declining as much as they were. And then we look at a regional banking ETF and compare that with the financial sector, just showing that the regional banking ETF continues to really underperform. Then looking at the financial sector, where we broke out here, and what's once was, okay, let me try that again. What was once resistance now becomes support. And as we've been coming back down, we're wondering, will this level provide support? It's been doing that before, but right now we're still far away from that level, so I haven't been showing this. Then we look at a ratio of the QQQs to the diamonds or the Dow, and we're seeing that their relationship is not all that strong currently. And then we want to compare the Dow with the transports. When the red line is dropping down below the black line, that means the transports are underperforming, and that's what we're seeing in some of our studies. In a good, solid environment, we want to see the red line outperforming the black line. Then we look at the cumulative new highs, new lows for the NASDAQ, and I go through this and I mention it in every video, but I haven't been showing the chart. And we can see that for quite a while now, we've really been declining with this overall indicator. And when we're below zero, that means we're negative here when we measure the NASDAQ new highs minus the new lows. Some rate of change charts, I have a lot of them. I just showed the 250 period here, where we're continuing to go up. So we're not seeing a lot of weakness longer term. This is also a further back look at the 250 period rate of change. The other rate of change charts that I have, I bring them up just as things are happening and the charts are telling us something. Then we have the S&P on top, which is in red, and then the TLT, which is the long-term bond ETF. That's on the bottom. It's kind of strange here. You can see where the red line's been going sideways, the blue line's been going down, but yet the longer-term relationship seems to be improving, but the shorter-term relationship seems to be weakening. And then I measure the spread between the two down at the bottom. So we're not really getting a lot of insight from this. Looking at the yield curves that we follow, and I mention this in every daily video, all of these yield curves remain inverted. And then this is a bond to stock ratio, just showing how bonds have been underperforming stocks. And then we do value to growth and take a ratio. That's the black line here, where it's been showing a little bit of improvement as value's been outperforming growth in the short term. And then we plot that with the 10-year yield. And we look at the relationship between the two, but it's pretty much neutral right now, so we're not really being told much. Then we look at a ratio between the Qs and the long-term bond ETF. They are having a tendency to go in the same direction. Stocks have been under pressure. Bond prices have been under pressure. They both have been going down, so this relationship has been going up. And then we look at the equal weight S&P 500 and then an inverted version of the MOVE index. It's not really telling us anything right now. And this is a newer study. I'm still trying to kind of figure this out. The MOVE index has not been around. It's just been available for the last few years. So there's not a lot of historical data to really go back and test this. So I'm kind of figuring it out in real time. Then we look at the 3-month yield, where we climbed above where we were back in 2007. We're waiting to see if we roll over and start to come down. Is that going to give us a warning sign? And then I go through the possible positive scenarios, and these usually come into play after we've really been declining and we're looking to bounce. But then we can see the overall strength of the market. Is growth or value outperforming? Well, one way to measure that is looking at the QQQs and then taking a ratio between it and the S&P 500, and we're pretty much on the moving average and declining slightly, even though longer term we're still going up. We're seeing some improvement with discretionary to the S&P, and large cap growth had been performing large cap value, but now it's been seeing some weakness. Then we look at the growth to value ratios with the large caps showing some weakness, mid caps, and the small caps. And this is coming through in the weakness that we've been seeing in the market. Then we take a 10-day average of the S&P 500 highs minus the lows. We tend to use this like an oscillator when it's extreme positive or negative. We can also get a bias here. When we're above 50, we're positive. Below 50, that's negative. We're just barely above 50 right now. And then we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of their highs minus the lows. When we're above zero, that's positive. When we're below zero, that's negative, and we are below zero. Then we look at the percent of stocks above their 200-day simple moving average. This is similar to the 250. Okay, let me back that up. The 200 period and 50 period moving average study that we looked at a few minutes ago. This also can be used like an oscillator, extreme positive or negative, and where are we in relation to 50? And then we look at the 50-period exponential moving average of the new highs minus the new lows. When it's in this blue area, it's positive, but you see how we're declining here. So I haven't been showing this. I've just been saying that it's positive, at least for now. And then that comes from the next chart. The black line in here is the actual indicator. And then on top of that, I have a 50-period exponential moving average. And that's the red line that you saw in the previous chart. We're showing a little bit of an improvement here, but we have been declining lately. And then we look at the 19-day exponential moving average of the advanced decline ratio. Where are we in relation to the zero line? Are we above or below zero? We're slightly below based on price and volume. We can use this like an oscillator for extreme positive or negative readings. And then the S&P 500, the stocks that are above or below their 50-period moving average, also like an oscillator. Where are we in relation to 50? We're at 43 right now. We also look at that same thing for the mid caps as well as the small caps, and things are pretty negative, at least in the shorter term. And then we look at the 2-year treasury yield. Sometimes when this spikes up and comes down, that might give short to intermediate term support to the S&P, but it just hasn't been happening lately. Thank you. I hope you found this helpful. Please feel free to check out the other videos to get more context of my approach to technical analysis. I hope you have a great weekend, and I will talk to you in the next video.